everyone, and welcome back to Investing for the Common Man. Today I want to take a few moments to give you all an update on what's going on in the markets and address a disturbing trend that I have noticed reading news headlines and scrolling through all of these YouTube videos predicting another market crash or a retest of the stock market's March lows. Headlines like this can be very scary and deceptive. It is important to remember that no one has a time machine or a crystal ball, so no one actually knows what will happen in the future. We have to remember that the news outlets and YouTubers make money solely based on how many people click on their headlines to view their content. They are not incentivized to provide reliable information or accurate headlines. So all of these headlines are really just clickbait. I even watched a few of these where several minutes into the video, they walk back the certainty of their doomsday prediction in their own headline. So today I want to take an honest look at the markets and give you a few of my own thoughts and observations. First of all, we need to consider what a stock market crash is and what circumstances it takes to trigger a crash. A crash is a sudden and dramatic decline in stock prices across a large cross-section of the market, leading to a significant loss in paper wealth. Stock market dips and fluctuations are routine and expected, but crashes are a relatively rare occurrence. Going all the way back to 1772, there have only been about 24 recorded stock market crashes in the United States. For a stock market crash to occur, there have to be both a surprising change in economic factors or information available to investors, and a widespread panic to essentially cause everyone to try and sell all of their investments at the same time when very few people are interested in buying. With that information in mind, let's take a look at our current situation. We recently experienced one of the fastest and largest market crashes in history. This was not triggered by the existence of COVID-19. Or even when it started to spread to countries outside of China. It was not until investors realized that the virus would not be contained and would cause local, national, and global economies to essentially shut down under strict quarantine measures that would last for months. If we fast forward to today, the numbers of new infections have peaked in most states and nations across the globe, and many businesses and economies are making preparations to open up gradually with many new health and safety regulations. We are certainly not out of the woods yet in terms of economic stress, due to high unemployment numbers and businesses operating at a decreased capacity to continue social distancing measures. Over the last month and a half, the major US markets have rallied halfway back to their all-time highs. Many analysts originally thought that the indices would retest their March lows, but as the market continued to rebound over the last month and a half, those analysts predicting a retest have become fewer and fewer. This is primarily because the stock market is not an indicator of the current health of the US economy. This is a common misconception. The stock market is an indicator of the future expectations of the economy. To get an idea of this, let's look at a specific example of one of the companies hardest hit by this pandemic. Right here we have the chart of Brinker International, stock ticker symbol EAT. This company owns Chili's and Maggiano's Little Italy restaurants. This stock is traded around $40 to $45 per share with relative stability and a healthy dividend yield of about 3% before the pandemic. But it tumbled all the way down to $7 per share, a drop of over 80% during the market crash. The only reason that a company's stock would drop this much is if investors were convinced that the company had an incredibly high probability of both cutting their dividend and going bankrupt, rendering their investment completely worthless. Since then, the federal government has stepped in with nearly unlimited economic stimulus to prevent companies like this one from going bankrupt. In addition, EAT reported earnings last week and revealed that they still turned a healthy profit in the first 3 months of the year, and have been transitioning into robust online ordering and food delivery systems. They also have not cut the dividend, which means that at $7 a share, the dividend yield for EAT would have been over 20%, which is just absolutely absurd. In the last month, this stock has rallied over 200% off its lows. For the stock market to crash again, something new would have to happen to put the future of companies with high pandemic exposure like this one back into jeopardy. The other piece of the puzzle that we have to consider are the big tech companies like Amazon and Netflix, whose businesses are not only unaffected by the pandemic, but whose revenue is actually booming due to increased demand for entertainment, communication, and productivity in the stay-at-home and work-from-home economy. Amazon stock sold off by 25% in the crash, but it quickly rallied more than 50% up to all-time highs as online orders and cloud demand boomed, proving that Amazon is an essential company to get the entire world through this health crisis. Megacap tech companies like Amazon, Facebook, Google, Apple, and Microsoft make up over 20% of the S&P 500, not to mention the other tech companies in high demand like chip makers and video game developers. And with their businesses stronger than ever, it is unlikely that their stocks will participate in another market crash related to the pandemic. Besides, if you consider how many headlines and people seem to believe that there will be another market crash, that means that there are definitely investors sitting on the sideline with large piles of cash waiting for this crash to happen so that they can then buy up all these stocks when they are super cheap. This might seem like a great idea, but if there are more than a few investors with deep pockets doing this, they will be the ones creating increased demand as stock prices drop, which will drastically mitigate any market sell-off, preventing a complete crash. The market has already shown us which companies are the clear winners and losers during a pandemic. The healthy companies that have proved that they are basically impervious or even thrive in the stay-at-home economy have likely become core holdings in many portfolios, so it is unlikely that they will dramatically sell off again. It just doesn't make sense. Again, I want to reiterate that I'm not discounting the fact that our country has many obstacles to overcome before this global health crisis will seem like a distant memory, and there's likely more pain to come. But to trigger another market crash, we would really need to experience another surprise regime-shifting event. So let's brainstorm for a minute. The most likely cause of another widespread sell-off would be a series of company bankruptcies that cause a domino effect, with more and more companies filing for bankruptcy. The only problem with this scenario is that the Federal Reserve has already made it clear that they are essentially willing to lend infinite amounts of money to prevent that from happening. Another possible scenario would be if we experience a massive second wave of infections that cause the entire country to go back into strict quarantine for several more months. A second wave of infections is possible, albeit a grim scenario. But COVID-19 is not going to surprise an unprepared world again. We are at a point at which scientists and healthcare professionals have had months to study this virus and develop care methods, social distancing guidelines, and start working on antiviral treatments and vaccines. Just this week, a study concluded that a drug called remdesivir could help get people in and out of the hospital faster and decrease the mortality rate. And on Monday, news came out of Oxford that it is possible that they could have a vaccine ready by as early as September. Between the progression of scientific methods of treatment, as well as a large percentage of businesses and individuals practicing heightened hygiene standards and social distancing, I find it difficult to believe that any second wave that does occur will be rapid enough or great enough in magnitude to cause a second market crash in rapid succession. The only other scenario that I can come up with is that the US and China are plunged into another trade war based on accusations and demands for retribution. I find this a little far-fetched because even if government officials pursued that, if you think back to the trade war that occurred over the last year and was further complicated by an impeachment trial, nothing happened suddenly or definitively enough to cause a market crash. It just increased the market volatility. If you have any other ideas of scenarios that could cause a market crash, I would love to hear them in the comments below. Maybe I'm wrong, so I'd appreciate your opinions. If you don't mind, please take a minute to support my channel by subscribing and hitting that like button for the YouTube algorithm. This week I'll be releasing a video revealing 5 stocks that are on my watch list and I plan to trade in the month of May, so you won't want to miss that. Until next time, keep calm, stay healthy, and happy trading.